Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will speak about the rebalancing and diversification return in cryptocurrencies.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. In today's video we will again speak about the cryptocurrency and we will describe one interesting phenomenon called diversification rebalancing return. A long time ago, before the elevators were a thing, there was a simple mechanism that was used to get miners in and out of the mines. It was called the main engine, or in German language, Fahrerkunst. It was working on a simple principle of two ladders that were moving up and down. So when you stayed on one ladder, you got nowhere, but when you jump between one and the second ladder at the right time, you can easily get out of the mine. And there is an investment strategy that works on a similar principle. Now try to imagine that you have two assets that have a high volatility but zero return. And similar to ladders, when we buy both of the assets or when we buy just one of the assets, we will not gain any money. But if we buy both of them and rebalance them in the right moment, we can get an interesting performance, so-called Rebalancing Premium or diversification return. So it's a premium that investor gains from periodically rebalancing portfolio. Now let's try again to see an example. Let's imagine that we have a portfolio that consists of 40 assets and each asset has a mean daily return of 0%. And the daily volatility of around 7.5%. These are the average numbers for average cryptocurrency assets. So on average, the performance is very close to zero, but the cryptocurrencies has usually a very high daily volatility. Now we generated synthetic data, and the following figure shows the cumulative returns of all of those assets are the synthetic data. Now, as we can see, neither of the assets consistently outperforms each other, but it can be a good candidate for the rebalancing premium. So now the next step, we compared how a buy and hold portfolio looks compared to daily rebalance portfolio. So what does it mean? We can have a portfolio that buy and holds all of the 40 assets and doesn't rebalance. Then we can have a portfolio that buys all of the 40 assets and rebalance every day to the same weights. So daily rebalance portfolio. As you can see, the daily rebalance portfolio has a significantly higher performance with higher volatility, but it's profitable with a small drawdown and nice Sharpe ratio. The anomaly is also analyzed in a nice paper, Diversification Return and Portfolio Rebalancing and the Commodity Return Puzzle by Claudio Landro. If you want to learn more about that, I would recommend to look on this paper. This paper is talking about the commodities and it shows that the similar effect is also present in commodities. On average, the individual commodity has nearly zero performance. So when we have a portfolio of multiple commodities, let's say 30 or 50 commodities, or commodity futures, and we rebalance this portfolio automatically, we receive a positive return from the commodities. This positive return comes mainly from diversification or from rebalancing. Let's move to cryptocurrencies and let's see how the rebalancing of cryptocurrency portfolio would look like. So in our analysis, we built a portfolio that consists of 27 cryptocurrencies on a time period from end of the 2018 until end of the 2021. The portfolio consists of multiple, mainly large cryptocurrencies. And we analyzed three strategies. So the first one is benchmark strategy. So it's not rebalanced at all. So we buy cryptocurrencies at the beginning of the period and we hold them until the end of the period without any rebalancing. So we let the weight drift. The cryptocurrencies that perform well have a higher weight. The currencies that doesn't perform well will have a lower weight. The other two strategies, we set the simple equal weights at the beginning of the period and then we rebalance daily or monthly in the case of the first strategy. And let's take a look on the resulting equity curves. So market cap weighted benchmark has the lowest performance, the daily rebalance portfolio has the highest performance, and monthly rebalance portfolio has a performance between that. So each of the two portfolios that are rebalanced have higher return than the portfolio that is not rebalanced at all. The difference is really significant. Of course, the daily rebalance portfolio has a better performance, better Sharpe ratio, but it's sometimes very expensive to rebalance portfolio daily, but we can get a lot of the outperformance by just rebalancing monthly. So in case we know that the daily or monthly rebalance portfolio has higher performance, we can try to calculate what is the actual outperformance, what is the alpha of the daily or monthly rebalanced portfolio. In this case, we can do it by building synthetic long-short strategy. The synthetic strategy goes long the daily rebalance crypto index and shorts the market cap weighted benchmark, so the benchmark that let the weights of the cryptocurrencies drift away from the early weight. We do not need to short 100% of the benchmark. We can short a lower number of the benchmark. Our portfolio has the highest Sharpe ratio and the best car to maximum drawdown ratios in case when we short not 100% of the benchmark, but something between 50 and 80% of the benchmark. This rebalancing of the cryptocurrencies works well also when we combine cryptocurrencies with some stable and safe assets. For example, we can combine cryptocurrencies and bonds. We are using IEI iShares 3 to 7 year treasury bond ETF as a proxy for fixed income or for bonds for safe assets. And then we are testing multiple portfolios when we combine treasury bonds with cryptocurrencies, and it can be market cap weighted benchmark of cryptocurrencies or daily rebalance or monthly rebalance index of cryptocurrencies. What are the results? The results are that in all of the cases, it makes much more sense to combine fixed income safe assets with the cryptocurrencies and then rebalance them. Of course, if we do not rebalance cryptocurrencies, our resultant performance is higher because cryptocurrencies performed well in the past, but the resultant volatility and resultant drawdowns are significantly higher also. So the resultant Sharpe ratio is much worse than in case when we rebalance our portfolio monthly or daily. Analysis answers us whether it makes sense when we have cryptocurrencies in our portfolio, if it makes sense to rebalance them back into the stated rate, let's say 2 or 5%, or if it makes sense to let them drift. Our analysis shows that it really makes sense to rebalance them to stated rate that we decided at the beginning, not to let drift the rate cryptocurrencies in our portfolio. That's the conclusion. There is one important information that I'd like to mention. Now, this rebalancing works well because cryptocurrencies mean revert to some common average. Now, it doesn't make sense to rebalance portfolio if there is an outlier that is strongly trending. It happened exactly in 2010 with commodities. We did a test of rebalancing premium with the commodities. What we found out is that commodity their rebalance index was outperforming or performing nearly the same with the market cap weighted benchmark, so the benchmark that let weights of commodities drift until around 2008. But afterward, there were some commodities that started to have a very significant trend compared to other commodities, and in this case the market cap weighted benchmark let weights drift, and those two commodities had higher returns and also higher weight in a resultant portfolio. So the market cap weighted benchmark outperformed the daily rebalance. This rebalancing premium or this rebalancing or diversification return works well in portfolios when we expect that the resultant asset will mean revert to common average. It's usually the case of the cryptocurrencies, but it was not the case for the commodities in the last 10 years. So if we expect from the assets that they will drift, it's better to have the market cap weighted benchmark, so the benchmark in which we leave the weight of the underlying assets drift. If we expect mean reverting behavior from assets in our portfolio, it makes sense to rebalance our portfolio. So as I mentioned, in cryptocurrencies it was the case, so it really made more sense to rebalance the portfolio in the past. So thank you very much, and I hope you join us in our next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.